Hi everyone, this is Dimitri Pergamonic with MarketChameleon.com. I wanted to show an example how you could use the credit call spread screener or a bear call spread screener. So we have a bearish market outlook here, and what's happening is it's a strategy where you sell a call in one expiration, one strike, and you're buying a call at a higher strike. So you're receiving a credit. So in this situation here, this would be the credit here. So this is the August 16th, 147, 150 call spread in Microsoft. And right now you'd receive a 17-cent credit. Your max risk here is $2.83 because it's a $3 call spread. That's what it could be worth at expiration if the stock finishes above $150. And since you received 17 cents, you could still lose $2.83. So that's your max loss. Here's your credit. And before we do a screen, I just want to explain to you this table over here. So up here we have the different filters that you could use, and you could switch the filters up here. So you have a couple folders here. You also have different views of the data that you could switch this way. Let's just concentrate on the summary right now. And since you have a bearish outlook, one thing sometimes you could do, maybe you want to hedge against your own portfolio that you have some stocks in there, so you could look for opportunities in your watch list, or if you're just looking for some bearish opportunities, there are also these stock ideas here. For example, something near the 52-week low, maybe market laggards. These are stocks that have been lagging the market or fall the biggest laggards in the S&P 500. Also over here you have moving averages, so something that's maybe in a downtrend or just did a fast bearish crossover. Then you have these, and you could read about them over here. So you have ideas here as well if you're looking for bearish plays. So that's this underlying stocks filters over here. I'm going to go back to the option spread parameters, the main one, and let's just switch right now. It's set it for the first monthly expiration, but let's look at all expirations within the next 30 days. So this is going to refill our data in the table below. So you see it's going after all the expirations that expire within the next 30 days. So we have over 208,000 entries down here. And right now, it's all sorted by highest market cap. So here we have Microsoft. This is the credit for this July 26, 138, 140 call spread. We think it's worth $1.61. So there's a slight edge. So remember, when you're selling a call spread, you want to sell it above a theoretical value. If you're selling it below a theoretical value, then it's a negative edge. And this is your historical win rate when applying this price, the market price, to historical price return distributions, and we'll go over that in the analysis in a second. Another thing you could do is set a cushion to the upside, and what this is because it's short, you may want to cushion to the upside, or let's see how that looks. So let's say 2%. So in other words, the stock can still increase in price until you hit your break-even point. So so over here we could see that the stock is well below the 149 strike. So as long as it stays below the 149 strike, then you're good. So it could still increase from 140 to 149 to collect this credit at expiration. So you have a 6.4% cushion over here. And what this is here, if the stock remains flat, then you stand to make 3.2% on the money at risk. So you're risking $3.39 to make 11 cents credit as long as the stock stays below 149. So that's your return if the stock is just here or goes lower, or obviously in this situation stays below 149. And you could also set that to some kind of a minimum, let's say 5%. And that's going to reload all the selections over here. Now, let's look for positive edge trades. And to do that, we go here to the theoretical edge, and let's just say we want at least 10%. That means we want to sell it 10%, at least 10% higher than the theoretical value. Like over here, and the theoretical edge is taking the difference between where you sold it and the theoretical value, and then dividing it by that max loss. So that's your theoretical edge over here. Also, you might want to set a theoretical win rate for history above 70%, let's say. So now what this is doing is making sure that all these are above 70%. So let's just take a look over here at the analysis, and I'm going to hit load here. So we see in XOM credit call spread, we're selling the 77.5 call spread for 40 cents. The stock price is 174.82 right now, so it's below the 176 strike. We are adjusting it here for dividends, so there's going to be a dividend during this period, so we're adjusting the price for the dividend. And here, there's 16 trading days to expiration. So all these we know ahead of time. Now here, if the stock remains below 76 or below, it could increase by 2.8% or below that, then this call spread is going to be worth 0 at expiration because it's going to be below both strikes. If it goes above 77.5, or if it increases by more than 4.8%, then this call spread will be worth $1.50. The difference between the two strikes is $1.50. And then if it lands anywhere in between 76 and 77.5, or a plus 2.8% to 4.8% return at the end at expiration, 16 trading days, it's going to be worth anywhere between 0 to $1.50, depending where it lands in between these strikes. So now we don't really know the probability of this happening. We don't know for sure if it's going to be below 76 or above 77.5. So what we want to do is look at historical data for our guidance. So here we're going to run a test here. This is the study theoretical value of the spread using historical stock return distributions. We're using 4 years of data here for 16-day hold interval. And actually here there's going to be earnings periods, so we're only looking during earnings periods in the last 4 years. So over here you see there's a little E here. That means there will be an earnings before August 16th. So now we're only looking what happened during earnings period, and here are the results. So 87.5% of the time the stock did not increase by 2.8% at expiration. It was below that, so this would have been worth 0 this times. Above 4.8% of the time, that happened 12.5% of the time, and this spread would be worth $1.50. And in between, remember we're only looking at earnings periods. That didn't happen 0% of the time. That's 0. So we do 87.5% times 0, 12.5% times $1.50. In the last 4 years, if you did this similar spread over and over and over, the average price was 19 cents. So that's how you get the theoretical value here using the price return distributions. And this win rate over here, 87.5%, means that 87.5% of the observations were below this 40 cents, right? So you needed below 40 cents to be profitable because you took in a credit of 40 cents. So you could see here is a loss, 0 zeros. So in this situation, it was either $1.50 or 0. And you could also just go here if you want and change it to 6 years of observations. And if you wanted to expand that, and then you could do the same thing for 6 years. So 6 years, now we have 24 observations, and you could see it was pretty consistent that way through 6 years. So again, this is only looking during earnings periods historically to capture that earnings move, to see how a similar call spread with the same distance away and the same amount of days to expiration during the earnings periods behaved. So we could see that over here. Now, if you want to take the earnings periods out you could come over here and just say find me anything with earnings after expiration, then it will list you here, and then you could just keep narrowing it down. Now we're down to 63. We started with 280,000 observations. Here you could also see any known event. Maybe you want it after expiration, so let's see if that narrows it down. Okay, so that would take it down to 0. So that's how you could just keep narrowing it down until you get the ones that you feel the most comfortable with and that meet your specific criteria. Thanks for watching, everyone. See you next video.